Hey, welcome aboard. It's Walter here, and from Naked Trading. Naked Forex is the book I wrote. Full-time trader. I'm going to share with you an interesting thing because this comes up a lot. And before I forget, if you like what we're talking about today, you'll want to check out nakedtradingclass.com, and there you can get a free on-demand training on how to build up an account quickly using 3 different methods. And we know that there are 3 things that we need to get our trading up and running and basically to find consistent profits. You have to have a system you believe in that makes money. You have to have risk rules that will allow you to achieve what you're trying to achieve. And you'll also need to have the mindset or the trading psychology right so that you execute your system and you do what you're supposed to do according to your rules. That can be the trickiest part, but that comes in sort of, usually for most traders, that comes in last. So what I want to talk about now is something that's like when I did my doctorate in psychology, there's a whole lot of talk about randomness because chaos theory was a big deal back then. You've probably heard of chaos theory and fractals and all that. And a lot of the academics will talk about how the markets are random. And so that's kind of like a dismissive way of saying that if you make money in trading, it's all luck. And so people will often ask me, well, why would you trade if the markets are truly random and it's a, quote, random walk? Why would you even trade? Well, here's what I'll tell you about this. And this is interesting. Let's say that you're a guy and you're single and you say, hey, that girl over there is pretty, I like the look of her. Maybe I should go say hi. Maybe I should go say hi. Oh, no, she probably won't want to have anything to do with me. It's not worth it. Maybe I shouldn't go say hi. And so you're kind of tossing it up in your mind. Should I go see her? Should I not? Well, that's kind of like trading. And the reason, and I'll bring this back around in a minute, the reason why it's like trading is because if trading is truly random, and there are things that are random in the markets, and I believe that to be true, and if there are things that happen in the markets that are not random and enable you to have an edge and to pull profits consistently out of the market, which is also true. By the way, all these academics who write these books about random markets, you'll notice that they never make any money from trading. Interesting, isn't it? So what we know is that if that's true, that there is a random component and there is a non-random component, then you can trade. You can. You can make money from the markets consistently if you simply apply trading system rules that have an edge. Now, how do you know if it has an edge? Well, it's simple. What you need to do is come up with a strategy. You can find them on the internet. I've got plenty in my Naked Forex book, whatever resonates with you, makes sense to you. You back test it. And then what you really want to do is run through multiple iterations. The reason why you'd run through multiple iterations, or what we call Monte Carlo tests, is you want to see the range of possibilities. Because on any given system, when you decide to trade it, if I decided to trade my system today and you trade the exact same system tomorrow, even if we take the exact same trades at the exact same time and all that, which is probably not going to happen, but let's say that we both do, we will both have a completely different experience with that system. Because I took some trades today that you didn't take, and your first trades are tomorrow. So that's part of what trading is all about, is about deciding, what's going to happen if I take this path with this strategy? And when I do, how do I know if I'm on the right path? How do I know that things are going to work out for me? So what you do is you run Monte Carlo tests, and these tests will enable you to see the percentage of times that this happens, drawdown, percentage of time that you hit your targets or what have you. The point is, it's a great way to determine whether or not you're on track. Now, here's another thing about this. I believe that the markets are random, that there is a lot of random noise. It goes up and down, up and down, up and down, kind of randomly. But there are also edges. And the reason why there are edges or predictable moves in the market is because humans are behind it. Until the robots completely take over, humans are the ones making trading decisions. And humans have particular mental shortcuts that we take. We try and take all the information in around us. And instead of trying to process every single minute of the day, information, we say, oh, well, that's a dog, or that's a mailman, or that's a car, or that's a train. And we're very good at that. But what we're not good at as traders is understanding that we have biases, cognitive biases, thinking mistakes that we make over and over again. And all the other participants in the markets do the same thing. For example, a big one is when the market goes really far, really fast, we assume it's going to snap back. That's probably the biggest number one method of trading for most traders, especially when you first start trading, is you think that, oh, it's gone too far, it's going to come back. And you'll see that a lot when you look at all the trades that the beginners are taking. You can find these on the internet with the open position ratios, and they'll tell you this is what everyone's doing. They're all buying the euro or selling the pound or whatever. You'll see 80% of the traders are doing this, or 22% of the traders are doing that. And we use that sort of stuff in the way that we're building up an account quickly. If you want to learn how to build up an account quickly, you can go to nakedtradingclass.com. There's a link down here or up here. It'll take you to the on-demand class, and you can figure out if one of those three methods might work for you. So if there are random components and non-random components, how do they work together? Well, there's fluctuations in the market that are random, but also there are key points in the market where I think it's very easy to see when the psychology is coming in, when our market participants are all deciding to do one thing. If they want to zig, we want to zag. If you're an investor like Warren Buffett or someone who just buys stocks and holds them, you have a basic belief that the market is going to go up. Now, you know that in any given year, any given week, any given month, the market may fluctuate up and down, but you believe it's going to go up. That's totally cool, and that's fine to have that bias. I, as a trader, believe that if I backtested a system and I see it work in my backtesting, and then I trade it on a small account and I also see it work, that is worthy of more risk, and then I will use more risk with that strategy. That's my bias and my belief. But I know that there's going to be fluctuations up and down along the way, and that's the random part of it. So that's basically how it works. The question comes down to this, and we're going to get back to the idea talking about the pretty lady over there. The question is this: if you see the pretty lady over there and you don't know how she's going to react if you go over there and try and strike up a conversation, is it worth it for you to go over there and talk to her? Because if it is, if the payoff, potentially marrying this woman and having a wonderful life with this woman that seems to be the woman of your dreams, if that payoff is worth it versus the downside, which is rejection, and maybe she just said, go away from me, or get out of here, I don't want to talk to you, or something, whatever the worst case scenario it may be, if that's worth it to you, then you should go talk to that lady, right? You should go talk to the woman. Same thing with trading. If you have a trading system that you've backtested, you know it's going to work, or you think it's going to work based on past data. We don't know what's going to happen in the future, but you think it might. Then you trade it in a small account, and you do well with a small account. Guess what? If that's true, you should probably trade it with the live money, right? With a bigger account. And I believe the exact same thing. And the fluctuations, the movements up and down, those don't really matter, because that's the random part of it. Any given trade might be a winner or a loser, but overall my edge is going to work. And the only way you can get that is by building up your confidence. So I hope that this helps. If you'd like to see how you can build up an account quickly using 3 different methods, you can go to nakedtradingclass.com, click the link below or above this video, and I hope that it helps. I wish you happy trading, and we'll see you in another video. Bye.